Alright, welcome to our weekly update on Australian property market. We run it from the sunny climes of Queensland, where by definition we discuss waves, impulsive waves and corrective waves around Australia. The forecast for this week according to SQM is Sydney flat, Melbourne up, Brisbane up. If I missed any of the capital city, leave it in the comments below. So why are we here? Because interest rates are up for the 12th time and we want to know whether there is more rises to come and how it will affect property prices and broader economy. Let's talk about waves, shall we? We have been pumping it for a while now. The fuse is lit and it's slowly burning. We've gone up and slightly deflated, but it's still going on. When will it end? My answer is soon. In the previous episode, we talked about the correlation between US bonds and interest rates. At such dramatic rate of falls, no wonder credit got cheaper and house prices have gone up this much. But the sugar hit had to end at some stage as the US bonds bottomed on the 4th of March 2020. From then on we started a new bull run on US bonds, which has just concluded the third wave and currently undergoing a correction as wave 4. It means that over the next month or two we're going to have more hikes. What comes after that? An official drop in interest rates, as bonds will go through a major correction. It's going to be fascinating to watch how the public sentiment is going to change as the house prices will start climbing higher again, with mainstream pundits claiming this time is different. Unfortunately, the sugar hit is going to end abruptly, as central banks will probably start panicking about inflation again. This time, they're going to seriously try to curb it down. It's going to be a shocker. We'll leave it for later on. Let's look into the broader chart of the house prices to find out where we are sitting in a cycle. Here is wave 1, wave 2, wave 3, wave 4, and finally wave 5. As we go through the final 5th wave in a cycle that is spanning over 50 years, we need to be mindful that this wave is also made of 5 smaller waves. And guess what? We're entering the final stages of the conclusive wave. As this chart provides a broader picture, we need to get our magnifying glass to get a better image of particular waves. And as we know, all suburbs differ depending on the state and postcode. I'm going to start with postcodes that clearly illustrate our position in a cycle. This time we're moving to New South Wales, to Sydney suburbs of Bankstown, 2200. We are starting reading the chart well within the 5th wave that eventually will end the cycle. It needs to go through all 5 mini waves within. Again, guess where we are in the mini cycle? The first wave started here. This is the 2nd, 3rd, and we're well within the 4th corrective wave, which may retest those lows. It means when we hit this resistance line of 93,400, and we should bounce back into the final 5th wave. That will eventually end the big cycle that lasted for more than 50 years. How far will it go up? It's hard to judge. I don't want to overshoot it, but it can go as far as 1,710,000 based on Fibonacci extensions. Apartments, on the other hand, run on a different treadmill. The charts are not as volatile as with the houses. While the amplitude is smaller, we can still count waves. For some reason, in many postcodes, prices spiked around the year 2017. I'm not sure what could have caused it from the fundamentals point of view. Nevertheless, the peak corresponds with the 3rd wave. It means that for apartments, wave 4 has lasted for the past 6 years. It looks as if final 5th wave hasn't started at all. It also means we are going to see huge fireworks once the 5th wave starts, especially towards the end of it. Definitely we're going to overshoot the 2017 highs. It's hard to imagine such scenario in the current interest rates environment. We need to be mindful though of incoming drops in interest rates. Rules of nature can't be changed. As we know, there's no more new waves up past this point in a wave theory. We are going to end this large cycle that spanned for over 50 years. Probably it's going to be caused by double-digit inflation and therefore double-digit interest rates, which indicates what tail is wagging this elephant. We may speculate about migration increasing the demand for houses, but if interest rates are at 17%, there's no rational bank willing to lend currency to new migrants with a humble deposit. This subject is worth exploring. We'll pay attention to it in future programs. Meanwhile, stay positive. If you're underwater, it won't last long. You're going to have a short-term reprieve to refinance and be mindful of incoming icebergs.